Thank you for joining me. I'm Gord Long. A reminder before we begin. Do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. There's an old investigative adage that the secret to solving a mystery is to follow the money. The mystery today during the fourth turning is where are we headed, and specifically, how should I best prepare for this age of uncertainty? In this session, I want to follow the money by exploring what gold, the dollar, Bitcoin, and oil, or what is often called black gold, all together are telling us. They are money. As such, I would like to cover the areas outlined here. I actually don't recall a period of such broad-based, overwhelming uncertainty nor overwhelming pessimism. Flip through the charts links on the right here to gain a clearer visibility of what I'm referring to. The links are in your recent April 27th Technical Analysis newsletter, and they go from, as you can see, consumer pessimism all the way down to media and MAGA pessimism. These are actually expected telltales of a fourth turning. Let's start with energy, as represented by oil, or as I just said, what has historically often been referred to as black gold. When energy and oil specifically fall significantly, it typically is indicative of slowing demand from a slowing global economy. A drop of over 50% in oil over the last 2 years, in concert with our observations on global activities, which we've been reporting on in our weekly reports, suggests this is a logical conclusion of what is actually occurring. We've also been talking about the fourth turning for a long time in our newsletters and videos. Our longtime subscribers should need no introduction to this particular illustration. I therefore won't spend any time on it, other than as an introduction to two other charts you may not have yet seen. In 1957, U.S. Navy Rear Admiral Hyman Rickover gave a speech explaining the importance of fossil fuels to the economy and to the military. He then explained that we could not expect fossil fuel extraction to last very long. It is an unpleasant fact that according to our best estimates, total fossil fuel reserves recoverable at not over twice today's unit cost are likely to run out at some point between the years 2000 and 2050, if present standards of living and population growth rates are taken into account. Much modeling has been done since that time. Researchers at MIT did a series of analyses, which they published in 1972 in the book The Limits to Growth. The most recent update to this analysis shows the following summary exhibit. Output of the recalibrated Limits to Growth model were published in 2023 with Gail Tyberg's labels showing which lines are industrial output and which are population. The 1972 model and its update both look at the world economy from an engineering point of view. The analyst ignores the role of governments, debt, and many other things important to the economy. The original authors of the 1972 Limits to Growth analysis said they didn't have much confidence in the accuracy of the forecast after the decline had begun because of many other omitted factors. The disturbing thing from the 2023 analysis is that it shows industrial output dropping about now. This is what you would expect to happen if there is a big drop in world trade. The world economy is at a major turning point, which is why we should brace for rapid changes in the economy, which we're seeing. The world is moving from having enough goods and services to go around to actually not having enough to go around. That's what's coming. The dynamics of such economy are very different from not enough to go around. The hope for solutions of higher prices doesn't fix the situation. After a point, adding more buying power mostly produces inflation. Other solutions are needed. The world economy is reaching what has been called the limits of growth. We've concluded we are entering a beta drought decade and are likely in the early stages of a major unfolding bear market. We are strongly seeing growing indication of recession odds. Risk sentiment appears to be holding firm, even though news over the period suggests traders should position themselves for another drawdown. The U.S. economy shrank for the first time in 3 years during Q1. That is for a period before the White House unveiled its so-called reciprocal tariffs, which will surely have a further damaging impact. Hours after the GDP print, the Bank of Japan slashed its growth forecast for the current fiscal year by a half. Add that to news out of China earlier last week, where purchasing managers reported a dour set of numbers for economic activity in April. Meanwhile, oil prices just keep sliding lower and lower. Traders can point to abundant supply, but a 20% slump in crude since the start of the year is equally a sign that demand isn't keeping up. The upshot is loud and unequivocal. The global economy is weakening. Yet look at how equities bounce back. The S&P 500 index fell less than a net 1% in April, an incredible rebound after having slumped more than 20% from February's market peak at the start of the month. And for all the tariff upheaval, the Nasdaq 100 is close to retaking 20,000, a level that would have seemed a dizzy high just a couple of years ago. April witnessed one of the best rebounds since the 50s, from a 14% drop down to just 1.5 month to date as of last Friday's close. A force of positive tariff news and stocks lifted for the sixth straight day, the best stretch of gains since March of 2022. President Donald Trump may have put many tariffs on hold, but with no signs of trade deal with China, the prospect of empty shelves in the U.S., higher prices, and an inevitable slowdown in the U.S. economy is becoming very real. Former Treasury Secretary Janet Yellen is out warning that the chances of a recession are way up in the wake of tariffs. In turn, that points to shrinking earnings of corporate America. While the Fed focuses on the deeply flawed and highly gimmicked official economic data in the U.S., real-world signals are telling us the economy is rolling over in a big way. The earnings season just ended had discount airline Southwest CEO Bob Jordan noting that air travel is declining in a way not seen since the pandemic. Jordan commented, and I quote, "I don't care if you call it a recession or not. In this industry, that's a recession. Southwest is not the only company noting a sharp decline in consumer spending and economic activity. Pepsi cut its earnings per share forecast for the entire year amidst heightened economic uncertainty." That's what they called it. The company's CFO stated, and again I quote, "We are probably not feeling as good about the consumer as we were just a few months ago," and noted consumers were even pulling back on buying snacks. Chipotle, which is usually one of the strongest fast casual restaurant chains in the U.S., just reported its first decline in same-store sales since 2020. Management noted that consumers are cutting spending amidst economic uncertainty. Read recession is coming, if not already here. Walmart CEO has noted what he calls budgeted pressure consumers, where they're exhibiting, and again I quote, "stress behaviors due to money running out before the month is done." This is Walmart we're talking about, noting consumers are tapped out. If airlines, snacks, restaurants, and even discount retailers are all noting a sharp pullback in consumer spending, what do you think this means for the economy? The answer is simple. The economy is rolling over in a recession, if we're not already in one. And you should look at the latest Market Lab report for details on that. This is going to potentially panic the Fed into a truly insane amount of money printing, and the markets now know it. A tsunami of liquidity, money printing, may be about to hit the financial systems, likely by Q3, maybe a little later. As I wrote in last week's newsletter, Bernanke printed $2 to $3 trillion in 3 or 4 years. Powell then turned around and spent $5 trillion in 18 months. More and shorter. This time, it's going to be, my guess, $7 to $10 trillion growth in the Federal Reserve's balance sheet, and very quickly. Even a mild 5% contraction in earnings from 2024 would leave the aggregate earnings per share of the S&P 500 basket at $225. Which would be roughly commensurate with a value of $38.74 on the S&P index. The S&P 500 is almost 2,000 points higher than this level. The markets may well live in denial for a little while, but the longer they do so, the more pain is storing up for the future. Well, who do you believe? Bonds and commodities are yelling recession, while stocks are shrugging off any weakness. Treasury Secretary Bessent mentioned that he thinks rates should be lower and brought up the fact that the 2-year yields were well below the Fed funds rate. And as Jeff Gundlach constantly reiterates, and we believe strongly also, the 2-year Treasury always leads the Fed. It's not the other way around, and it's telling us where things are going. In our latest Market Lab, we laid out a raft of supporting charts that a recession is increasingly a strong possibility. Here are just 4 of them, which we encourage you to study along with the other charts in the lab report. There is a reason the greatest investor of all times is sitting on cash now, approaching $350 billion as we issue this video. His famous Buffett indicator, shown in the insert, supports his positioning. His cash holdings could buy actually over 475 of the S&P 500. If he is right, he may own the entire S&P 500 by the end of the decade, or sooner. Veteran emerging markets investor Mark Mobius says cash is king as he waits for the trade war storm and mounting macroeconomic headwinds to blow over. And I quote him, "At this stage, cash is king. So 95% of my money in the funds are in cash. Right now, we've got to keep the cash and be ready to move when the time is right. If the market comes down further, of course, we'll put more money to work." Mobius owns a little bit with the S&P 500 fund, so to track the market, and expects higher prices by the end of the year. But he also says Trump doesn't want to see a big market crash, so he'll be making adjustments and announcements which will give a little bit more confidence for people in the market. At least that's what Mobius says. Eventually, the global liquidity proxy will take control back from the market traders and speculators. That's a given. We just are debating here how quickly that happens. We've been operating in a unipolar world since the end of World War II and the Bretton Woods construction of the new post-war world order. It established the U.S. dollar as the global reserve currency, which in turn established the U.S. Treasury note as the risk-free benchmark. It has worked amazingly well and almost unquestioned for close to 70 years. That period is over, as we quickly move to a multipolar world with other strong global military and economic economies besides the U.S. That expected transition is well underway. It may be moving like a slow-moving glacier. We don't notice it, but it keeps on happening, and it's not a slow-moving glacier now. Analysts have found that valuation is actually not a catalyst for movement in the U.S. dollar. However, it is still helpful to think about fair value when trying to understand how far the U.S. dollar can adjust if economic or market conditions change. Recently, the U.S. dollar's strong valuation has been driven by elevated global allocations chasing superior return prospects in the United States. With those returns now eroding, currency analysts expect the dollar misalignment to erode gradually as well. This chart shows the U.S. dollar is overvalued relative to Goldman Sachs' well-followed Deere model, but the gap is closing. The question is, how overvalued is the U.S. dollar? Fair value for the DXY has remained relatively stable over the past 15 years. In the year since the dollar rally in 2021-22, it has since sustained an overvaluation around 20%, though the year-to-date dollar softening trend has cut that valuation gap in half. Current valuation, therefore, estimates imply that the dollar, after recently falling, is probably 9% overvalued on a DXY basis, and maybe 13% on a trade-weighted basis. The Deere model has been a primary model for assessing foreign exchange fair value at Goldman for almost 30 years now. Currency fair value is hard to pin down because there is no underlying cash flow, but this model assumes that real exchange rates mean revert over time. But differences in productivity and terms of trade will influence the underlying trend. This is basically a purchase price parity model and currency lingo with some twists. The model has 4 parts: the long-run average, relative rates of inflation, productivity, and terms of trade. In practice, for a currency like the euro-US dollar or the British pound US dollar, the long-run average is the dominant driver, with inflation differentials providing a supporting role. For currencies like the Australian dollar, terms of trade, commodity prices will play a bigger role. Productivity will have a bigger impact on emerging markets. Valuation gaps take roughly 5 years to close, with approximately a 20% per annum conversion rate. Further out, spot tend to hover around fair value before overshooting at the 8 to 10 year horizon. The empirical evidence suggests investors should not be surprised if currencies continue to appreciate or depreciate once they reach fair value, although there may be too much uncertainty to explicitly forecast this sort of overshoot long into the future. It depends on the currency pair, but in general, when comparing currencies to other asset classes, fair value isn't as strong an anchor or stopping. In the current environment, it's likely corporate and pensions to really watch to see if a big trend is kicking in. This is because they own assets and assume liabilities denominated in a range of currencies and then choose whether to hedge their exchange rate risk. They got way overexposed to dollars, believing the EU would continue to struggle economically, the Ukraine, etc. Trump mistakenly threw everything he had at Canada with his talk about a 51st state. The US dollar couldn't hold above the 1.44 level. In markets, what cannot go up soon comes down. We're at 1.38 with every Canadian pension and corporate now caught offside, desperate to sell every rally, which they haven't been able to get out. How many times in our career have we seen gold up, but stocks down, bonds down, and the dollar down? It signals people have way too many dollars. Trump can't afford a recession if he's going to get his tax cuts passed. The U.S. budget deficit remains about 7% of GDP. A recession would push it well into the teens. Trump faces the same risk as former UK Prime Minister Liz Truss, what we call the Liz Truss movement. She too ignored experts and went all in something that made no sense, and she was gone. Will institutions soon be forced to panic into gold as a dollar hedge? As an asset class, it's completely undervalued. The current buyers of gold and gold bullion are the central banks and retail through ETFs. Institutional buyers are still noticeably missing, but we believe they're coming. But they're not here yet. It'll take an action or an event or a crisis, but it will happen. Bitcoin is also underowned, but this is likely to change also in the not-too-distant future. We believe that for a number of reasons. One is that capital has begun to flee places like China as economic conditions worsen, and other countries as investors look increasingly for some sort of safe haven and flight to safety. Many corporate CEOs are stating that getting their profits and capital out of China is becoming increasingly more difficult. Chinese citizens are also nervous about that. We just saw Apple move its production from China to India. Why? They want to keep their capital liquid. Bitcoin is currently almost the only easy solution to these kinds of problems. Many investors, like ourselves, see capital controls coming with the next financial crisis and are getting ready for such. As the flows chart on the right illustrates, Bitcoin is beginning to separate itself from gold. As Standard Chartered recently reported, Bitcoin is a superior financial systems hedge compared to gold because of its decentralized nature. First, strategic asset reallocation out of U.S. assets may drive Bitcoin to fresh all-time highs. Secondly, several indicators support this thesis. Term premiums, Bitcoin time of day analysis, accumulation of Bitcoin whales, ETF flows from gold into Bitcoin. Thirdly, timing the upswing is tricky, but we think it's imminent, and we expect fresh all-time highs in Q2. As a result, as the chart on the left illustrates, U.S. investors have been buying Bitcoin since the 90-day tariff announcement. The chart on the right shows whales are now back in Bitcoin, or at least getting back in. As we recently showed in our weekly technical analysis report, we suspect when Bitcoin breaks the prior highs, it could explode higher, as we saw when it went from $200 to $20,000. Time will tell, but certainly worth watching closely. So what can we conclude by following the money here? The longer-term trend is clear based on what we know. However, this is the fourth turning, and you can expect the unexpected of major policy pivots and announcements. What we focus on is risk-adjusted investment. Like Buffett and Mobius, we are in cash. Our equity holdings are primarily limited to precious metals, defense, and a few other plays. When we say cash, we're talking currency, hedge, treasuries, and bonds in the 1 to 5 year duration range. We'll wait for the equities to offer better risk-adjusted returns. That day will come. Maybe quite a ways out, but meanwhile we're making nice money, and we actually think we'll even make capital gains on that rather than just pure interest. We'll watch closely to see if our multifractal Elliott wave pattern, WXYXZ, continues to offer us guidance. It is critically important and why we've been talking about it and showing it for quite some time now. Taking it to smaller degrees because it's working over multiple levels of degrees consistently, we see it as another proof of point. We can't wait to see how it plays out. But like Warren Buffett, we follow his 3 proven rules of investing. 1, never lose money. 2, never lose money. And 3, never forget rule number 1 and number 2. As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems until such time as no one will take that money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currency, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there's actually seldom been a better time for investing. However, it requires careful analysis and not following necessarily what has been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2025 turn out to be an outstanding investment year for you and your family. I sincerely thank you for listening.